Shares of Twilio getting hit hard today. The software maker reported Q1 results last night, surpassing expectations, but investors focused on the Q2 guidance, which shows a deceleration of growth to 4 to 5%, down from 15% in Q1. Morgan Stanley saying in a note, the quote, "The stock will likely linger here absent any activity around the collapsing share structure in late June," unquote. Twilio CEO Jeff Lawson joins us now from San Francisco. Jeff, good to see you. So within the context of the dual class structure going away starting in July, explain to me how Twilio accelerates out of this period and why it should stay structured the way it is now.
Well, John, thank you for having me. You know, there's two parts of our business, right? We've got a communications business, which is usage-based, and the usage of our platform really tracks to our customers and how much activity is going on in their businesses. And so when the economy contracts or pulls back in its growth, I should say, and companies like are spending less on marketing, for example, to bring customers to their sites, right? That drives less usage of our platform, and it kind of is what it is. And on the downside of the economy, on the backside, it means more decelerated growth for us. And that's unfortunate, and that's why we have the guide we do. But the flip side is when things pick back up, we see a pretty quick re-acceleration of the business because that reflects more activity, and that happens much more quickly than a traditional software company, which is out there essentially selling seats that then have to roll through into revenue. We see a pretty direct correlation between what's happening in the economy and what's happening on our platform. And we've called out several industries like, retail or on demand or social media or crypto as things that have been headwinds for us in this kind of economy. And most of those, with the exception of crypto, I'd say, I think can turn on pretty quickly when the economy changes.
Okay.
In the coming, hopefully weeks and months. But exactly when that happens, who knows? I don't have the crystal ball. I think everybody wishes they had that crystal ball. But what I can say is we've got a customer base of 300,000 customers that really span the entirety of the economy, of the globe, of every sector you can imagine. Startups, big companies, AI companies. And so I think you can expect that we'll track to the track to the economy.
I want to ask you now about AI as a piece of that eventual growth, should that arrive, because everybody wants to talk about AI as if it's all upside, but some companies are starting to get whacked by it in the short term. So explain to me what Twilio's moat is in that situation. Do you have data that you're able to train AI on so that you can say to your customers, hey, you need to stay with Twilio, maybe even on this premium level of service, because we're going to allow you to send more effective messages to your customers? Or are potential competitors going to be able to enter the market and undercut you using AI?
Well, that's a great question. Just a couple of years ago, we acquired the leading customer data platform called Segment. And what Segment does is it allows companies to really gather all the data about their customers, like all the signals you're getting from how they use the website, the mobile app, and all the information that's trapped in all these myriad systems that are traditionally siloed, and bring it together into one profile of a customer. And now when you think about where AI is going, the large language models themselves, there'll be many options out there, and every company is going to use them, and every capability will be powered by many of these language models. But the language model is only as good as its understanding of who it's talking to. And that's where Segment comes in. The data that we have about our customers' customers can be combined with these language models to power some amazing experiences. And if you think about two worlds, one where I'm having some sort of conversational experience with a company and that bot knows nothing about who I am or what I represent to the business or what I've bought or if I'm a great customer or a bad customer, versus a world where I'm chatting with a bot and it knows everything about me. It knows everything I've ever bought. It knows my spending potential. It knows if I'm about to churn. We can bring that intelligence to the applications that our customers are building. And that's the conversation that I'm having with our customers today.
I guess that's also the argument for keeping the pieces of Twilio together, is that you need the communication capability and you need the data capability if you're going to execute on AI. Do I have you right?
Well, that's the whole point. That's the reason why we're bringing together communications, which is how you engage with a customer, and data, which is how you understand the customer you're engaging with. And it's only when you bring those two together can you really have an effective way to talk to your customers. When you talk to them, but you're not particularly relevant, or you don't know anything about the customer, well, that's not a great customer experience. If you know your customers really well, but you don't use that understanding of your customers to actually drive all the touch points between sales, marketing, service, in product, etc., that's not a great customer experience. So it's
Meantime,
the fusion of those two that really allows us to create this customer engagement platform, which is the real opportunity going ahead.
Meantime, how tightly are you committed to managing the bottom line? Are you hitting those cost-cutting targets as quickly, faster than you expected?
Well, I think, as you can see, we take investor feedback very seriously. We've took a number of substantive actions in Q1 to bring down our cost, including a restructuring of the business, a reduction in force, a stock buyback, and a number of other things. And you see those decisions now rolling through in the first quarter of execution, where we jumped to a 10% non-GAAP operating margin in this quarter, as well as brought down our stock-based compensation substantially and laid the path for our execution towards not just a non-GAAP profitability company, but of course a GAAP profitable company in the coming years. And that's what we're committed to doing. And I think our profit results in Q1 really demonstrate how seriously we've taken those actions and how well they're actually working already.